Hello, welcome everyone. Let's get underway here with start off with market analysis here. Let me actually pull up my little drawing guy, and we are good to go. Let me get that out of the way there. Market conditions having a little bit of a sell-off here in S&P 500. We'll look at that. Let's start off with kind of broad-based perspective and the long-term market timing signals as far as direction alerts. Just to rehash current market conditions, pardon me, bullish in a bull market, sitting at a rank right now of 26. So this line has really been accelerating to the upside and is as high as it's ever been. Same with the market, S&P 500 making all-time highs as well. So we've had a really nice run up here, certainly due for some type of a counter trend correction. We saw the momentum indicator moving up into this extreme range, and breadth bumped up a little bit yesterday, but not a whole lot, and it is improving. We'll see what happens today. We're getting a few sectors that are continuing to move. Buy-sell ratio is sitting right around 1.94. You can see those are starting to come back together again, but oftentimes when we do get some of these rallies, these can come back together and then they can expand apart again. The issue in this rally recently has been that we just haven't had a lot of participation, all market conditions moving higher. We've seen only a handful of stocks. So if and when NVIDIA and the rest start to reverse, S&P 500 is going to move lower. It doesn't necessarily mean this entire market could move lower. It's actually starting to improve. So there may be some rotation happening here as well, out of some of those real popular names and over into something a little bit more small cap. If we look at the market the indices here, the ETFs, this is the Russell 2000. Okay, Russell 2000 having a massive update today. So we're getting a shift out of an S&P 500 is getting a little bit of a downturn right here. So we've seen that with NVIDIA as well. We'll go through some of these other names as we start to pull those up, but some interesting market internals happening. We still have bonds doing what they need to do. Now we've actually got it bumping up into that upper momentum zone or upper bullish trend zone, not a momentum zone quite yet. It's got to reverse quite a bit, but that's actually an interesting move that's happening right here of some coming out of some of these larger tech names and going into bonds and going into small cap names or some of those Russell 2000 names. That's kind of the quick glance as of today. We'll see where things close out. Sectors also, if we look at sectors, we did see a few more moving into this buy zone, and we're getting almost all short-term uptrends. Let's see what the averages are doing today. Yeah, that'll move short-term uptrend up and today. And let's see, what was the other one here? Energy. Don't know where energy's at. Yeah, there it is. It's so some bullishness, even though we're seeing S&P 500 names starting to reverse. This is going to be the big issue with S&P 500 is that we are sitting. We go to this. Actually, let's go here. Indexes. These 130 names. You've got NVIDIA, Broadcom. Really, those are the top two. So NVIDIA is having a pretty decent down 5% today as well. That's the bulk of what's moving the S&P 500. We probably have Amazon and the rest. So here's Amazon also moving lower. Let's see if Microsoft is in here. Here's Microsoft. Microsoft also moving lower. So really, you've got three, of those names, even four. Google is sitting right here, and those 4 or 5 names are going to move the S&P significantly. So it's kind of the upside of this market move has been a little bit deceiving because it's only been a handful of names, but this retracement may be interesting because we're still getting more participation now, but just in other stocks. So maybe just some profit taking here as well, which is fine. It's always interesting because market conditions are never the same, but they rhyme. There's similarities in what's happening, and so part of what we're watching is to see some of these things that might be shifting. And we also know, certainly that we're getting a shift over into commodities. Commodities have had this nice run. Silver's been making a big move. here in the last few weeks. Well, the last week, it's up in this upper momentum zone now. You're getting a little bit of a pop there today, 1 or 2%. We also saw a USO bouncing off the 236 right here. So you're getting this support range, 236. This is typically what we want to see and expect to see when we have an uptrend. The Fibonacci level connecting this high, this low, and now this upper range. This upper range is where we want to see most of the action. This is where we typically want to start participating in some of the action as well. And so when that starts to happen, we're watching for confirmation bars in that location. You get a pullback, confirmation bar. So that's a good solid buy location for USO to continue as it's pulling back. We'll see if that happens. Obviously, all kinds of things can happen, but in this case, this is a good example of a commodity as it has been reversing, moving back lower, and then ultimately, this is where we want to start to participate again, or where we can start considering it again. Once it bounces up and it starts to show confirmation in this range, this is one additional way to be able to enter into the trend as it's beginning or as it's starting to happen here. These are going to be some of those early trends. So anytime we're in this green zone, the green means it's trending. It's in an uptrend. Red means it's in a downtrend, and yellow means it's just pausing. It's either transitioning from an up to a down or transitioning from a down to an up. So the yellow gives us opportunities to kind of say, yeah, okay, well, it's on my radar. I'm paying attention now. Versus here, it's like, okay, it's on my radar. I was in the uptrend. It's on my radar. Maybe we're looking to exit versus maybe we're looking to enter. So the yellow is that indecision zone or that get ready type of zone, particularly if we're following the trends precisely, if we're only entering into the green or we're only getting out. In a lot of cases, the way we're managing some of these uptrends are we manage with the trailing stop, and oftentimes you will start to get a breakdown of these patterns in the hold zone at the trailing stop location as well. So in most cases, by the time we ever get back to a sell, that first sell, oftentimes we're getting stopped out as well because that is the price pattern that it's setting up. And we'll pull up a couple of additional examples here as well. In fact, let's do that now. So this current wheel portfolio, we've got a handful. So NVIDIA pulling back. There are a few other names that are in here that are, so Dutch Brothers, this is a good example to where we had entered in either here or here. It's been rallying, moving higher. It didn't move quite to that 20%. Right now, with the market conditions being how they are, we're taking some of the gains at the 20% level. It got to like 18% and retraced. But in this case, you can see now it starts to pull back and starts to find some support at that location. But we also get this color formation. And in the morning, in the Discord updates that I do in the portfolio Discord channel, we talk about this, where this is a range where it starts to, when we start to see this, it means we're getting ready to make a decision. We're either going to get stopped out of our uptrend, or we can say, I just don't like the number of holdings that I've got. Maybe I've got too many holdings and I want to raise some additional cash, and I've got 2 solid down days, and I could say, yeah, I haven't been stopped out yet, but I'm going to exit anyway. I'm going to exit the full position. So in this case, we did. This morning, we exited out of the full position of Dutch Brothers. It was about an 8 to 10% gain overall, and that's a scenario where it's like, well, I could have sold here and had another day up based on the rules we're following. We could have exited a little bit, but in this case now it's like, okay, well, I'm fine with that because we're following the process of exit. And in this case, if we wouldn't, the stop loss was a little bit lower. I think we had it just lower than this 37 range, but now once it starts to do this, we can say I don't necessarily want to wait to see if it does flatten and then roll over, or if it takes forever, a week or two, and then it continues this uptrend. Oftentimes when these really get these sharp moves, it takes a little bit of time for those trends to develop. So that's one of the other utilizations of the Fibonacci 236 level, particularly on this 6-month time frame. The 6-month time frame, it's going to grab this low and this high, and then we use that to create this framework of our trend. Okay, And as it's moving higher, we want to look for support resistance areas. We want to look for areas of trend to where if it does get weaker, if it breaks below that 236, it doesn't mean this uptrend is over, but it just means it's got a lot more work to do now to get back up into that zone. So we can wait for that to happen. Instead of sitting it out and riding along with that downtrend, we want to make sure that we're out of the trade, particularly if we're managing with a stop loss, and we want to make sure that we are exiting when we need to raise additional capital. Right now, this is being managed where we have around that 25%. We're a little bit higher now. We've had some things that are continuing to move, but if there are any weaklings in the group, then we can start to look at those on the next market open and say, okay, I want to get closer to 25%. I'm going to sell the ones that aren't working. And that is something like this, WGMI, which is a crypto ETF, crypto miner ETF that had this uptrend here, new confirmation. It's just kind of been floundering. So now it needs to either get moving one direction or the other, but this lets us know, okay, we're paying attention to what's happening around this 236 area. Is it going to hold support? We've adjusted a stop loss already. Are we going to exit? Are we going to maintain the position and wait for it to stop us out because we believe it could bounce? Those are trading plan decisions. When you get to that point and say, well, what am I going to do now? It needs to be in advance of the trading plan and say, I'm maintaining a 25% equity holding in the overall portfolio, which means I've got to sell something to get back to that balance. So what do I sell? Where do I start to do that? And that's going to be with either your losers to start out first, or if you have some winners that are approaching some levels that you can then capitalize on some of those gains. Like WGS is up 40%. As it approached that 20 to 25%, we sold half the position into that strength. So if you'll notice up here, we don't have a very big position of NVIDIA or WGS because we've taken gains on those already. The bulk of them, these are kind of runners that are moving on. So we've got some additional positions now that are open, and that's the current setup that I'm managing this portfolio based on the trading plan of utilizing. We're continually invested, but as market conditions top out or as they roll over, we're just trading with smaller position sizes and smaller percentages of cash. We've got most of it still sitting in cash. I prefer that at these levels. You may want more. You may decide, hey, I'm okay using 50% of cash because I've got XYZ amount and I want to be able to trade larger positions, and I'm okay with the amount of risk. I understand the risk that I'm taking. I understand that using 3 to 5% versus 2 to 2.5%, I can still manage that risk effectively by using position size and stop loss. Okay, those are the two things that we control. We talked about that on Tuesday, where when we add into a new entry, we say, let's look at this one, for example, RNA. Hey, here's the signal. Here's the morning. The morning of is typically the entry location and time frame. This is an end of day strategy, which means the analysis, we want to do it after the market is closed, and then we want to make our decision pre-market. Before the market opens, we will have seen this bar. We will have said that's one I want to take, and I'm going to buy at the market open. And so as soon as that market opens, then we would be a part of that buy day right there. Okay, and then I'm going to say, well, what's my risk level? I want to be able to know based on my account size. Okay, in this case, if I'm using 100,000 and I'm using 2% allocation, then I can go in and say, well, it's about 45 shares. Let's start out with 50. Let's go down to 45. That's 192. If I went 46, I'm looking at this number down here now. It's 1.96. If I really want it exact at 2% or as close as possible, then I'm 48 shares at $44 a share. That's my 2%. Now I've got 2% allocated in the trade, and I can also now go in and I can say, where's my stop going to be? Am I fine with having my stop initially below this 236 level? If my buy point is right here, that puts a stop loss at about 36.50. So if I go 36.50 here, That's 0.3. So that's the upper end of the risk profile range that we really want to have. We want to go 0.3 or lower than that. So in this case, my stop, I may need to increase my stop just a little bit. Sorry, I got this new microphone. I can't ever find the mute button so that I can cough, because that happens to me all the time. Where is this thing? Hang on one sec. Can't find it. Okay, back in business. So I may be able to change this stop to 37.34. That's still a little bit high. So I've got to go up a little bit higher on this stop loss to be able to manage it. So a stop at 38, which the low of this yellow bar right here is 38.36. So in order for me to keep my risk at 0.3 or lower for this trade at 2%, I would need to set my stop at 38. And that's fine, because in most cases, we don't expect the stock to hit that stop loss. It's just there for that what if, or, we know that stocks are crazy and that they can do anything they want to do. And so we want to always just make sure we have that stop loss in place, so that if there is a down day, something happens, some news items or anything else, that we're always protected with that stop loss. And once it starts to climb, once the price starts to climb higher after entry, then we can move that higher. We want to always allow for that little bit of that range, that gap. Okay, so we've got between the price and where our stop loss is. And ideally, it's doing this. We can move our stop, move our stop, move our stop, move our stop, take some profits in here. Now we've got a smaller position that is that's getting stopped out, and then we ultimately get stopped out of the rest of those. So, and that's kind of the situation we're in right now with those two stocks that I showed you with that have smaller position sizes, because we've taken some gains along the way. So that's essentially, that's the ease of that process. It's understanding what is my position size I want to go in with without a stop loss. That's this number, portfolio at risk of 2. Okay, I'm just using 2 because that's the number I'm comfortable with right now to allocate around that 25%. If I were going at 5% and I went to 100 shares, okay, now my allocations, if I'm buying something every day using this wheel methodology, then my whole I've got, I can rack up a pretty large position pretty quickly inside of the entire portfolio, versus if I'm continually trading something smaller. And you could do this, you can continue to do that strategy as long as maybe you've got a scan that you've set up and you're really comfortable with it, but it doesn't produce a stock a day, it produces one a week, or something like that. Then maybe you are holding a little bit larger position size, because your scan is very specific to what you're trying to generate. Maybe they're just all Dow stocks or really large cap stocks, or something along those lines in terms of the kinds of stocks that you're adding into and watching for. Those are I call them levers that you're pulling. These are the two things that we're controlling. We obviously are controlling or having help with the control process of the entry. The software is helping us look for these certain kind of stocks. We want uptrending stocks, high rank. We want them as they're entering back up into a momentum trade, back into this bullish zone, ideally in this upper 236 range of the chart. That's the structure of finding the stock and entering the stock. And then it's managing the stock that we've got to say, here's my number of shares and where is my risk, my stop price. These are the two things that are managing risk. And risk is being managed by the position size, because if we went all in and said we have 100% position, we have more risk, because there's more volatility. There's more chance that more of our money can move with the movement of that one stock. So in terms of diversification and allocation, we're still only using stocks and cash, but we're using that balance between stocks and cash, and we're adding into stocks that are ideally starting this new uptrend. We had an example, Dutch Brothers, we exited out of that. The new trade coming in, now the expectation is that new trade will kind of take over as it's moving higher, versus as a stock is completing its trend. Another stock will have been doing the same thing, but maybe it's now on the way up and it's right here. So one of the stocks is exiting here, another stock has already done that. and then we want to jump back into that. That's what we call the wheel strategy, where we're doing that every day. And so we're managing a group of stocks every day, and market conditions kind of control that as well. As market conditions are really strong, we can go a little bit higher allocation and more stocks in the holdings, versus right now where markets are they're still quite bullish, but we're just at the upper end of this range, and there's some macro considerations that we just want to be aware of. You know, the biggest one is this bond yield curve that at some point is going to correct itself. That's one of those factors that we can analyze market risk by determining where are we at in the current trend, and is the probability of us continuing this current trend high or low? Well, it's lower than if we were earlier in the trend, right? But we don't know how high it can go. We also know that it needs and can correct, and that there's a lot of froth in the market. There's a lot of feel good in the market. Well, how do we know that? Okay, well, we know that because of this sentiment number down here. Okay, this tells us there's extreme complacency. Okay, this line is at the top of the range. Oops, let me get this is at the top of the range, versus down here. When markets are selling off, it shifts the fear greed continuum. And that is, when markets are selling off, we get to the point that we don't want any part of stocks. Okay, well, when they're doing what they're doing now, where things are continuing to move higher, there's just no fear of owning stocks. That complacency will shift quickly when selling starts to happen. Then you're going to get two things. You're going to get profit taking, number one. Then you're going to get fear selling, number two. Okay, and it's like once selling begins, selling creates more selling, and selling creates more selling, and then you get ultimately a capitulation at the bottom, where everybody's, they hate stocks and they've sold, and it's the last sellers to sell. Well, what happens when there's no more sellers? Buyers can start to come back in. So right now we have no more buyers. Who else is going to be buying? Everybody that's buying is buying, other than more institutions, and you may get some of this FOMO money that's starting to come in. Oh, markets, I open my statement and I see markets are going higher. Well, yeah, they are going higher, but they have been going higher, and so it doesn't necessarily mean now's the time to be piling in to this uptrend. Okay, so it's just about risk management. If that's the risk you're willing to take at these levels, then fine, as long as that's allocated to say I could get some volatility that I'm not okay with in the overall portfolio, because even though we have diversification of stocks, they can all go down, and they can all go down at a certain percentage, but they typically don't. Some will go up, some will go down, and that's kind of the fun of managing it this way, is because you're getting, some of these that are continuing to win, like Nvidia. Nvidia is up 38%. We bought here, sold a little here and here, and have a smaller position here. And we'll do that, but with 15 to 20 stocks at a time. And it really is not that difficult to be able to manage that many utilizing this methodology. Let me just jump back. We'll kind of summarize here on, the other thing I wanted to touch on today is, remember to utilize the muscle ETFs, because they're really helpful in analyzing, or at least recognizing what some of the core trends are. And obviously we're seeing these gold miner stocks. We're seeing gold moving higher. So here's a way to be able to participate in a theme, okay, in gold, all of the gold mining stocks, without having to pick the right one, okay, or silver stocks or bank stocks. Like right now you've got regional banks 3x, which means this is moving higher, but this is all of the banks right now, and it's a 3x leverage. So you're getting, so if the regional bank sector index is moving up by 1%, this is going to move up by 3%. So it's a way to be able to, you're still getting kind of a bang for your buck that you would with an individual stock, but you're able to trade the entire sector and do it leveraged. It's just another tool to be able to do that. Same with some of these other mining stocks. This one's not leveraged, but here you're getting silver mining ETF. Okay, it's participating. It owns all of the silver mining companies, or a certain percentage of those. One place you can go and find that is if you go out to news here. This will show you. You can go to the holdings, of any ETF, and it's going, oops, I got the wrong one. Go to holdings, and then you can see what percentage of the stock. So you've got Coeur d'Alene in there, you've got Hecla, you've got Wheaton and Pan American. These are the two biggest silver. So the ETF itself is going to own these stocks or give you exposure to these names instead of having to pick up just one or two. So these are great ways to be able to, you can do the exact same thing because you can still use a percentage of your holdings into some of these ETFs and be even more diversified. So you're able to participate in, like this, iShares copper, metals, and mining, to be able to participate in the entire group without having to pick the right stock out of that group. And you know, that can help. Sometimes that can hurt. Versus if you did get the right stock that really in that group is really moving, and that's not as hard to do because here in sectors you can go to your sector scan, you can go to basic materials, and we can see the 22 stocks that are leading inside of gold mining, and we can also find which one of that group is leading based on percentage. So you've got GAU, which has had a nice move, and there's a nice setup as well. So GAU, gold, that's a gold stock, gold miner, nice setup in the buy zone. And then I've also got NGD. This one is starting to move. So there are certainly ways you go in and pick Harmony Gold, you pick some of these leading stocks in that gold sector, knowing that the gold sector is working, knowing that that's moving right now. And silver could be the same thing with any of these other ETFs as well. So just one of the ways to also utilize and look for a quick analysis of what you're looking for, what you're looking at and that day. And this is a great way to say, oh my gosh, I didn't realize silver is moving so well. So we get a big pop here today. And what does that look like? This looks a lot like what we've been talking about and will continue to always talk about, because this is systematic. It's the same thing. It's the same thing over and over. It's different stocks. It's different ETFs. It's different stories in the market that are taking place, but we're able to find those and focus on what is working currently. Will it always be that? Will it always continue to work? Well, not so, you know, no, we know that's not always the case, but we do know that once trends start, and we deal with whipsaw, with momentum trading, one of the things we deal with is whipsaw. Let's see if this is a decent example. A little bit, not too bad, but whipsaw is essentially where, let me go back to that NVIDIA chart, and because there was one example back here. So whipsaw is this right here. Whipsaw is when, and maybe even this, when you have a trend and it's a momentum trend, and it goes into this green zone. Okay, this is what we expect out of the green zone. We expect those to continue to trend, just like this one. But sometimes we get, it starts the trend, but it doesn't work, and then it goes back to red, and we get stopped out, or we exit that trade. We get one here, and we get stopped out, or it goes back to red, and then we finally get one here. This never turned red, so we would have maintained that entire trend. But these, they call them false breakouts or head fakes, or in this case, whipsaw. Whipsaw in momentum is, it just is in a range, and so it's not trending. Well, we want to focus on the trends, and we're willing to pay the price of getting stopped out, because these are going to be small. They're going to be, 8 to 10% stop outs in exchange for, 60, 70, 80, 100% move in the trending move as well. So the whipsaw is the price we're willing to pay to catch a potential trend, because what does every trend start with? Every trend starts with a green. Okay, no matter what, it's always going to start with a green. The question is it going to whipsaw and continue? Is it going to be stuck in a tight range, or is it going to be moving higher? So we also want high ranked stocks. The higher the rank, typically we're catching a good solid trending stock that's moving. The lower the rank, sometimes you get kind of these, crap grinding stocks that are either, they're probably trending down anyway, and we don't necessarily want to participate in those. We want the higher ranked stocks, we want the trending stocks, and we want to try and get into those as early as possible, but we can also trade them along the way. We can enter into the trend as it's moving higher. I think I'm going to end on that note. I sure appreciate everyone's time and effort, and have a fantastic weekend. We'll see you next time. Bye now.